Our next guest sees opportunity in one of the most volatile asset classes, high-yield corporate debt. The daring Jim Keenan is head of the leverage finance group and high-yield group at BlackRock, where he oversees $28 billion in assets. His high-yield portfolio beat 97% of its peers last year.
Jim, you have $30 billion to put to work. How do you put it to work right now?
I think right now you got to look past the short-term volatility. I mean, certainly there's a lot of debt in the world, and we're dealing with the burdens of that debt, and certainly it's moved on to the political front. But if you look past it and say where you're going to deploy capital, we're looking at long-term assets for like 3-4 years. You know, many of our clients have long-term liabilities, are looking to create income over the long term. High yield today is at about 800 over. That's 8 times the 5-year Treasury.
How much time are you spending with those clients right now? How panicked are they about the headlines?
Well, it all depends on the risk spectrum. I mean, obviously, everyone's focused on Europe right now, and probably in a week or so will be focused on the super committee. You know, clients are trying to figure out how to invest, how much to have in capital preservation, and how much to deploy in capital growth or income right now.
Well, clearly, if you're going into high yield, you have some sort of confidence that this is not going to be a Lehman-type scenario or something really doomy and gloomy.
Yeah, well, I think it's about how much capital you're willing to deploy. I mean, you know, right now, if you invested in high yield in May of 08 after Bear Stearns and held on to it to May of 2011, you made about 25%.
But who's
by
got
November,
the gut to do that?
Well, if you look at people with long-term horizons, all right? I mean, most of our investors are looking out for the long term. And on a relative value basis, where are you going to deploy capital? I mean, certainly there's a lot more volatility in equities right now. There's less liquidity in the market. But if you look at it and say, you know, the last 4 years, most companies have used the recovery in order to enhance their balance sheets.
On the liquidity front, what is it like for you to interface with the street right now? We just learned this morning corporate bond desks are holding the least amount of inventory they ever have. How are you getting business done?
Yeah. Well, I mean, I think you have to price that into your trading costs, right? I mean, in the long-term horizon, we're looking at things that who we're going to invest in over a longer term. Certainly the volatility on the short run, we're looking at it and saying we want to be the liquidity provider, right?
What about who you're going to trade with? Like, how is this MF Global, Jeffries situation? Are you concerned about these boutique dealers? Yesterday, Bill Cohen said to us, small boutiques are designed to fail. Do you think that's true?
Well, I mean, we study and we manage our counterparty risk. I mean, we at BlackRock internally, we manage all of our counterparties, their balance sheets, the risk that they're taking. So, I mean, obviously, most of our business is deployed to the more liquid, bigger shops just because of the sheer nature of the size. But, I mean, we're constantly looking for people and to create more liquidity in the market. Most of the street is not deploying capital.
So you want there to be more market makers out there?
We would love more market makers out there.
Do you have the stomach to go into European high-yield corporate bonds?
Yeah, about 2 months ago, we started to deploy more capital in Europe. We were seeing some anomalies there. Dislocation, obviously, especially on the northern side. You know, there are many global companies that do have operations in Europe, and they have debt there. And there were some instances where the European debt was trading 200 basis points above the U.S. debt for the same company. So we had deployed capital. Recently, we've pulled some back, but we do see opportunities.
So are you saying that going into high yield could perhaps be an alternative investment, almost a safe haven investment?
Well, I think you have
high yield, a safe haven. I want to hear you quoted high yield, a safe haven.
Yeah. High yield, I mean, over a long term, we think is a very good investment. Over the short term, you have to be willing to bear some of the volatility. So if you have liquidity needs in the short term, I wouldn't recommend any risky beta product. And high yield today is trading with a high correlation to the equity market. Over the long term, we think you are getting paid for it with regards to today's spread levels, the income relative to other fixed income assets, and the quality of many of the companies that we invest in.
So at least an alternative, not in a safe haven.
With your European investments, do you use sovereign CDS to hedge yourself? Do you consider it a hedge?
Right now, we're not using sovereign CDS to hedge ourselves.
Have you before?
We have at different times, but you know, right now, obviously, you know, right now we're just looking at where sovereign's trading. I mean, not investing in Europe is probably the best hedge right now. Italy at 660 yields on the 10-year is obviously creating a lot of questions about how do you price risk assets if you're looking at Italy as kind of the risk-free rate.
How is the Volcker rule, in the way it's written right now, going to affect BlackRock? If you run $30 billion and you need to reduce risk, who's going to be able to buy your bonds?
Yeah, I think if you think about, I mean, regulators are putting on things, all kinds of regulation to try to de-risk the banking system. The Volcker rule, as is, would probably decrease a lot of liquidity in many of the fixed income assets. When I think about that, I have to put higher risk premiums on assets because my ability to actually exit some of those investments if something was to change is going to go down. So with that, longer time horizon and a higher risk premium, and that increases the cost of capital to many of our companies.
All right, Jim, thanks so much for joining us here on InsideTrack.
Thanks
Jim Keenan, head of the leverage finance portfolio team at BlackRock.